Well, there's going to be a lot of them. We have the U.S. elections all the way in November. We have Brexit coming up in June. There's many things in between that. Also, the Federal Reserve. Are they going to raise rates in June, July? Is it going to be December? It's a lot of different things that we're all looking at, major catalysts in the market that might keep it pegged within a little bit of a range between now and then, broad range and volatile range, but range bound nonetheless.
We mentioned at the top there, obviously still the US Fed, one of those big catalysts. Larry, now that we've got through Janet Yellen's speech this week, I suppose the next big event to watch will be next week's June FOMC meeting. Is there anyone in the market who still believes they might raise rates next week?
There's not many. I mean, the odds, I shouldn't say zero because there's no such thing as zero odds. But it seems like it's next to nil right now for June. But that being said, there's still some hope for July, and I'm still in that camp that believes July still makes a lot of sense. I mean, I do know that growth and productivity are middling right now. But again, I go back to the point that this was considered an emergency measure. And raising rates is just a normal course of what they need to do. So, yeah, I don't think anybody expects June, but there are some people like me who do expect July.
Yeah, okay. And you mentioned the election there. Do you think that the Fed would want to get a rate hike away, maybe a couple of hikes away sometime this year before the federal election in November?
It's a good point. I think they would like to, but I don't think that that's going to be the catalyst on whether they do or not. But to answer your question, yes, I think in a perfect world, it would make a lot of sense to have one rate hike before that election, even though right now it seems like the presidential election, I wouldn't say it's locked up, but consensus seems to think here in America that Hillary Clinton would be the victor, and the House is still Republican. What everybody's worried about is Senate. The Senate race is up in the air, and to see what happens, and that could create a lot of uncertainty and volatility.
Certainly after that big miss in jobs there on Friday, Larry, we're now looking to other labour market indicators for clues on the jobs market, because we can't just rely on that one rogue number, which is basically what Janet Yellen has told us. But you are particularly concerned about the slowdown in jobs growth because firms might turn a bit more cautious.
Yeah, and I think another thing that we're starting to see the effects of, unbelievably so, is we are seeing pressure on wages. And that's something that people have been asking for and crying about for years. And finally, we're seeing that. And it's coming at a very, very peculiar time because we have a little bit of wage pressure and negatively offset by growth and momentum and productivity, all very stagnant over the last few months. And also you have commodity prices higher than they were even 3 months ago. So that might not be so good for the stock market indeed, especially when it comes to labor-rich industries like discretionary.
Well, speaking of the stock market, we've been talking about it for a little while now, but it's hard to sort of see what's supporting stocks. I mean, low interest rates is certainly creating this underlying bid for equities because there's no alternative, as some are suggesting. But what's justifying or backing these high valuations? Because it certainly doesn't seem to be the economy, and it's not earnings.
No, good point, but I think this is it. The V recovery that we saw, the rally has been 300 points since February. I think that is all due to what did not happen, as opposed to what did happen. The first thing is S&P valuations. The multiples went from 120 down to about 110. And so that kept the market down in that 1850 range back in February. That didn't come to fruition, and earnings per share was closer to $122. Secondly, Chinese currency depreciation, not as bad as feared. Even though the backdrop in China might be short-term negative, the currency did not depreciate. So we're back to where we were, back to those highs. Now, to go further from here, you have to believe in earnings per share being closer to $130 a share for next year, 2017. If that is so, then 17 times earnings would take the S&P 500 closer to 2,200. Definitely not unreasonable. To me, the risk is too high for the reward, but it's not unreasonable.
Okay. Also watching the yield curve with a lot of interest at the moment, because so we saw a big fall in those yields after that jobs report on Friday. Do you envisage them recovering over the coming weeks?
Yeah, I do. I mean, definitely we saw the yield curve bottom out to a point that we haven't seen in years, just back in May. And since that time, when there became more momentum that the Fed would raise rates, we saw that yield curve shift a lot. But yeah, rates have come down very, very quickly, especially the middle part of the curve. I don't see it shifting a whole lot, but I do see over the short term a slow rise back in yields, especially 10-year and 30-year.
Okay, I suppose a lot of it also comes down to your view on where you see the US dollar going at the moment, because that's providing a lot of direction for assets at the moment. The dollar's sort of near-term path does seem to be a bit clearer against some currencies than others. So take us through them.
Yeah, very good point. It's been a perplexing year for currencies after being so overly priced for so long. Then now people think it has a valuation problem on the other end. But I think a lot of this movement, I mean, obviously Aussie cross, Canadian cross, that's due to commodity prices in general. So put that aside and look at some of the other crosses. It's really the interest rate carry between the two countries. And so when you have perception here in the U.S. that the Fed's going to stave off raising rates for a while, you're going to see that currency depreciate versus some of the European crosses, or even in Japan, where there is a very good cross trade between the two interest rates. So really, it's all interest rate differential. Our country here in the U.S., the economy is still in good shape. It's just middling right now. It's just plateauing a little bit and digesting. It's really hard for people to watch it. It's hard for people to trade it.